Everyone. I'm Jim Henry, Senior Editor of Auto Finance News. I'm pleased to welcome you to this webinar, Taking Action, Strategies to Manage Shifting Credit Behavior, sponsored by Equifax and presented by Carl Stabler, Vice President of Risk and Analytics for Flagship Credit Acceptance. Lenders increasingly rely on more than just a simple credit score to judge an applicant's creditworthiness. Instead of periodic snapshots of a consumer's credit history, new data and new technology can create more of a moving picture of a customer's payment behavior and how it's likely to change over time. This is especially important in the subprime sector. Today's speaker is Carl Stabler of Flagship Credit Acceptance. He's responsible for reporting and modeling all information related to risk, credit, and portfolio level performance. Setting the stage for Carl is Carol Lunt, Vice President, Automotive Financial Services and U.S. Information Services for Equifax. Thanks again for participating in this webinar today. This pre-recorded webinar is scheduled to last about an hour. Carol, you're up.
Good afternoon, and thank you for joining our Auto Finance News webinar today. Equifax is pleased to have the opportunity to sponsor today's speaker, Carl Stabler, Vice President of Risk and Analytics at Flagship Credit Acceptance. And, as always, Equifax is happy to support the auto industry with advocacy papers, plus new products and solutions to help you understand your market better, to provide you with data and analytics for streamlining lending, and to help you optimize profitability. The future looks bright for the automotive industry. And in recovering housing and construction markets, plus lower fuel prices, it's not surprising that the 2015 consensus forecast for new car and truck sales is 3 to 7% growth. We believe that subprime auto loans have greatly contributed to this bounce back and will continue to serve as an essential tool for helping those consumers with less than perfect credit history get into a vehicle that fits their needs. In February 2015, we published a white paper that reported the future of subprime auto lending is sound. We reported on the performance of subprime loans opened in 2010, where more than 25% of them had improved their credit score by 100 plus points in 2013. In addition, innovation is drastically changing the landscape of auto financing. Today's automotive retailers and lenders have a new generation of highly sophisticated and effective tools available that help identify well-qualified buyers through rich data and insightful analytics. The days when credit scores alone drove lending decisions are almost gone. From real-time individual income and employment verification to overlays of behavioral data and alternative data, underwriters have more information than ever to draw upon. These and other advances in technology can help lenders lower risk, reduce fraud, remove STIPs, and in some cases, even provide a lower cost loan for borrowers. Thank you. And now I will turn you over to our speaker today, Carl Stabler from Flagship Acceptance, who will talk with you about his insights in credit risk behavior.
Thank you, Carol and Jim, and to your respective companies, Equifax and Auto Finance News, for providing this forum to discuss this topic, in which I find it powerful and relevant given our current market environment. Before I start, I'd like to provide a little more background about our company for those who are unfamiliar with us and to help provide further context in the information we are about to discuss. Flagship is an independent, growth-oriented, non-prime auto finance and servicing company. Over the past year, we've merged with Car Finance Capital, growing our overall managed portfolio to over $2 billion, with just under 700 employees across Pennsylvania, Texas, Arizona, Indiana, and California. We offer an indirect lending program through our expansive network of franchise and established independent dealerships, while our direct platform, carfinance.com, reaches customers looking to finance their next vehicle or refinance their existing loan. Through our existence, which I've been a part of from the start, we've developed several sophisticated models to better assist in our overall ability to effectively decision, originate, and service our portfolio, helping navigate the murky waters of the non-prime automotive environment. Since 2011, we've integrated several alternative data solutions to enhance our ability to understand our dynamic customer and drive competitive efficiencies in our operational processes and strategies. As Carol mentioned in her introduction, the typical subprime consumer has changed. The automotive finance landscape has evolved, and the tools currently available to us has made it possible to keep up. Has made it possible for us to keep up with the incredible momentum. Over the past years, the progression of alternative data has been remarkable, with big data driving dramatic innovations in behavioral economics and data science. Smarter, more advanced systems and software able to consume and compute massive amounts of information. Behavior algorithms have become more refined and mature and tested and time-tested. More and more data sets have become available. Data sets which have essentially been sitting on the sidelines have collected sufficient history to be robust enough to start making meaningful impact. There has also been a tremendous amount of movement in the business of alternative data through acquisitions, mergers, and internal model growth. Nationwide consumer credit reporting companies have increasingly been able to offer more comprehensive data solutions, making availability much more mainstream and obtainable for the typical lender. With that said, I think it's important to identify the types of options we have available to us and how they can fit into our current and potential strategies going forward. For the most part, alternative data solutions can be bucketed into two groups. The first group, which may be the easier to adapt to for new entrants, is time series credit data. This type of data can be considered more complementary, adding additional context to the traditional point-in-time credit snapshot. This type of solution adds depth by analyzing historical direction, velocity, tipping points, and degree of change, providing further insight into the consumer's credit behavior. I want to take a moment to kind of emphasize the distinction between point-of-time data available traditionally through your credit reports and time series data. Take an example of two applicants, both with a 40% revolving ratio. Now, utilizing time series credit data, you're able to identify one consumer has gone from 10% of their credit limit to 40% of their credit limit, indicating potential lift in risk. The other consumer has gone from 80% of their credit limit all the way down to 40% of their credit limit. Point of time data, you see just 40% of that revolving ratio, but with the addition of this insight, you can see two completely different stories and two completely different strategies in the decisioning process, knowing those types of insights. Other types of credit or time series data, credit card or credit score shifts, seeing shifts upwards or downwards in your credit score over time. Balance movement, are they building, are they reducing their balances and obligations? Credit card utilization and spend trends. How often are they using their card? What are they using it on? Is it seasonal or is it cyclical? And revolving behavior, which also could be a very powerful type of insight into knowing if the consumer that you're looking at is just paying the minimums on their credit or revolving trades, or is it more transacting and paying a more significant share. The second part, or the second group of alternative data is your alternative non-credit data. This is more of your supplementary type of information that is not typically available through your traditional consumer credit reporting avenues. This information provides insight into consumer behavior where traditional credit information is not available, insufficient, or incomplete. It also adds in a layer of information that can help mitigate risk in the non-prime, subprime customer profile where it gets a bit slushy. Go back to the example I provided earlier with the time series data and consider the person that's building up to the 40% credit limit, 40% of their credit limit. Now layer on top of recent utility delinquency and a recent payday loan inquiry, the picture gets a lot clearer. More examples of alternative non-credit data can be public records, a vast database of rental data, payday loans, utility and telecom payment histories, club and continuity, employment, estimation or verifications, checking, and self-reported type of data. With all those different types of sources, you can see the power in the multi-source risk-based solution, and you can't understate its value. Now I'm going to go through a couple groups of opportunities and strategies that this type of data could ultimately engage. First and foremost, it can help increase the precision and accuracy of your current models. Getting the infamous lift in your KS by optimizing your risk segmentation. Another great area and is also often overlooked in these types of discussions can be segmenting your thicker high-risk credit profiles. Additional insight can help lenders weed through the bushes, identifying customers with higher potential to pay. Alternatively, it can also help mitigate the potential false positives, identifying timely indicators of potential risk for traditional low-risk consumers, which could normally pass through without much concern by the underwriter or by the system's controls. The second part of these opportunities kind of looks at your increased ability to lend or broaden your ability to more accurately rank order no-file, bin-file populations. With this additional substantive information, it could help add depth and create a better risk profile in rank ordering your no-hit bin-file population. In a recent study by PERC Research and Solutions, they evaluated studies by many of the nationwide credit and alternative players, LexisNexis, Equifax, Experian, TU, FICO, all pertaining to the unscorable population. The results found that an estimated 1 in 4 Americans are traditionally unscorable, composed disproportionately of lower income, minority, younger and elder, and immigrants. Among these studies, most of the trends indicated that around 80% of those unscorable populations could be scored using alternative data. Furthermore, around 60% of that population resulted in lower to moderate risk pricing, essentially stating that these risk profiles of unscorables are not necessarily monolithic. Other opportunities of alternative data can be utilized in enhancing your current business processes and augmenting those strategies within your system. That could be fraud identification, predictors of bankruptcy, direct mail marketing opportunities, and tailoring your offers to a more responsive group, income estimations, and front-end verifications. In the same white paper that Carol had mentioned in her introduction, they also identified that borrowers who overstate their income on auto finance applications by more than 15% had a serious 60-plus delinquency rate, more than triple the rate of borrowers who didn't. Not only can that information help identify underlying risk of the loan, but if you're able to verify the income from the start, it could significantly reduce the burden of paperwork required by the consumer, making your offer more competitive and appealing to the dealer. So with all these great opportunities, why is everyone not utilizing this type of information? simply put, this data is not all created equal. If the data sources are not evaluated correctly, implementing such a solution could deem harmful results to your company. In the next slide, I've outlined 4 main components in evaluating potential data solutions which could produce the strongest potential results for your company. The first component of evaluating this data is ensuring that the data that you're looking at is robust and consistent. Make sure that it's nationally represented. Even if you're a regional type of lender, having nationally represented data can help make your data solution much more comprehensive and ensure that you're encapsulating all the pieces of the consumer that you need to evaluate. The depth of the data is broad and comprehensive. It's mature enough that you're able to perform retrospective analysis if you require such, and the attributes are defined and the data sources are well documented. Another big thing, and especially in this particular area of alternative data, is to ensure that the provider is regulatory compliant. Ensuring that the provider, working with a provider that has long history of working with regulators and source data suppliers are more likely to weather the changes in the regulatory environment. At the very least, they should be FCRA compliant with a process in place to investigate and resolve consumer disputes in a timely and efficient manner. The third is to ensure that the information is objective and unique. Data, make sure that the data is additive and complements information which is currently available through traditional reporting. Basically making sure that the data is not redundant and multiplicative. Diverse and independent and free from personal bias. This is particular around the social media, where personal bias can influence your overall score or your overall perceived risk. And the fourth component, and this is a major one, obviously, in wanting to move into an alternative data solution or using alternative data, is make sure that the data is predictive. Does it increase your risk estimation? Does it prove usable and correlate to your targeted behavior? And are you getting the lift in the lift in volume or potential lift in your KS? These are all 4 large components into making sure that your information is valid. Another piece, going back to your robust and consistent data, is to ensure that your data includes both positive and negative attributes. Open, current, and delinquent, not just bad. This is extremely important if your goal is to use this information to segment the no-file/thin file population. Lastly, once you evaluate all your information and kind of tailor the appropriate vendors that you would like to work with, there's a few other considerations that you want to look at. The first is consider the difficulty of integrating and the impact to your current systems. Make sure that find out if these vendors are currently integrated with your LOS system. Do they have experience with this type of information, or do they have experience with integrating complex business rules in your system? What type of timeline, resources, and costs will it take to implement? These are all factors you should evaluate at the start, not at the end, because it could add much more time to your project line if you start looking at this towards the end of your evaluation. Make sure, identify if this is going to affect your current state and how this information will be received and submitted back and forth to the various different vendors that you may be working with. The second part, and what we feel is one of the most important parts, is engage your legal and compliance team at the start of the process. This is extremely important given the current market conditions and the current current perception of alternative data. Engage your compliance and legal department to initially review the vendors you're looking at, to review the data that they're providing. Have them outline anything that they feel is blatant or uncomfortable, and potentially hold that out of your modeling sample as you're developing your validations and going through the process of trying to identify what pieces of this information work within your processes. Again, this is extremely important to continue to keep control around your systems and keep control around your data and make sure that everything's regulatory compliant with what you're doing with this alternative information. Gradually adapt and continue to evaluate additional enhancements within the alternative data. So once you go with an alternative data solution, don't go all in. When we started with alternative data, we went through the process in a very methodical way in our implementation. We slowly adapted this data into our models and strategies. As we became more comfortable and gained the ability to further validate its performance, we continued to increase its impact and fully integrate it into many of our current strategies and processes. The last one, the last hurdle, end user acceptance doesn't come easy. This is something that in our decisioning, we rely heavily on the discretion of our underwriters, and most subprime lenders will feel the same way. These underwriters take great pride in their experience and intuition. So when you introduce a component which looks to help automate some of their anecdotal assumptions, there's bound to be some pushback. I'm sure many of you can sit there and picture the person or the group of people in your credit department that you're going to go out and research the vendor that you selected and start looking through the list of data sources that they currently provide. They'll go through and see public records. Yeah, that makes sense. Rental data, okay, I'm okay with that. Utility and telecom payment histories, all right, that makes sense. But club and continuity? Now remember, if you go back to the last slide, one of the key aspects is in having independent, diverse data, one of the key aspects is to make sure that your data is independent and diverse. So if it meets that aspect, there's bound to be some data elements which may be considered unorthodox to many, but have high correlation to payment behavior. Now that person has convinced themselves that they know it all, that the know-it-alls from the risk department are declining approvable apps because this guy stopped paying on his National Geographic subscription. And now they're set out to outsmart the model, essentially invalidating your results. To control for that, make sure you have robust controls and monitoring set in place from the start, along with training and open dialogue with the team to help curb any of the future instances as they may become systemic. At this point, I've concluded the rest or my prepared comments, and I'm going to pass this off to Jim to follow up with a Q&A portion of the segment.
Thanks. Boy, that was very interesting. Could you circle back a bit and I mean, some of the this is all not to say that that you still include all the traditional data points and decision points, right? I mean, you're still looking at deal structure and credit score, et cetera, right?
Yeah, absolutely. And this is all just part of a component of your underwriting process. As a non-prime auto lender, the 3 C's are incredibly important, credit capacity and collateral. But with the current advancements in alternative data space, we can kind of add maybe a 4th C of context, filling in the gaps and kind of adding color and creating more of a sound picture of what the consumer looks like. But credit and structure are at most the highest impact in any of our decisioning models.
Sure. And can you mention any other types of alternative data that would maybe strike the veterans as unorthodox? I thought it was interesting the clubs that you mentioned, your National Geographic subscription. It reminded me I need to go renew mine. What are some other ones?
I mean, it depends on what kind of source you're looking at and how small of a data population that they have. A lot of the unorthodox data is more centered around social media and those aspects. Those aren't pieces that we incorporate into our information. I think the more mainstream ones are going to definitely be your club and continuity, some of your self-reported type of data points. But I don't know, depending on what data source you go out to, you're always going to find some interesting pieces. But it's all part of a suite of information that they're providing. It's not just that attribute that you're looking at. It's one of 30 attributes that go into a model that you're receiving that you incorporate in your decisioning. It's not the fact that you're just focusing on individual attributes and making decisions based on them.
Okay. And one of the things that we discussed before the webinar was, and you used a very telling example of somebody, two different consumers who are at the same point in how much of their credit they're taking advantage of, one on their way up, one on their way down. That was a great example. Can you think of other examples of two, the frozen in time look would look similar, but what are some of the other variables that would tell you that they're different?
There's a ton of different examples out there that people go through when they're looking at, how much lift can they get and how much insights can they get. If you're looking at point in time data, you're looking at a snapshot in time. You're looking at information that is very static. So adding, different elements in incorporating depth definitely helps in identifying new strategies and ways to deal with those consumers. Take, for instance, building balances on multiple cards, or making additional payments on principal, but now consider a customer that has made, has always made additional payments on principal and has been paying down its loan, but has now switched to, only paying the minimum payment for the last 6 months. That's a consumer that something may have happened, and that's a consumer that you may be able to derive insight from in using some of that alternative data. Furthermore, if you look at kind of the alternative, the non-credit kind of alternative data, looking at information where, you have a consumer that looks like they're a great consumer. They may be, in our near prime world, they may be like a 650 FICO, but they have, recent, they have a recent payday inquiry. They went late on their rent recently. All these indicators are indicators of, risk that could be much more timely than looking at it on the bureau, as that might be only relevant 4 to 5 months from now when they start going delinquent on other more traditional trade lines. It kind of offers a lot more relevant look into the consumer and into the consumer's trends, and also early indications of perceived risk or perceived improvement.
Okay. And I think I know the answer to this, but I think the desired outcome is making an informed underwriting decision. It doesn't necessarily mean that you would not lend to that person who has taken a turn for the worse, but it might mean you would price for the risk, and vice versa. As you said, some of them might be less risky than they appear, but the decision would still be up to the lender. Maybe I'm only asking you to state the obvious.
Yeah, in our risk-based pricing world, it's going to be more model-driven. So attributes within the credit, attributes within the structure, attributes within any kind of additional sources that you're bringing in are all going to kind of drive where that customer inevitably gets priced, and from there, there's not much movement that can happen unless the deal kind of changes materially in some sort.
Right. Okay. And you mentioned too that the end users may try to outsmart the model occasionally. Can you characterize aspects of this? I take it you do not do auto decisioning per se, but are there aspects of this that are kind of automated?
So We do auto decision, but purely on a decline basis. So it's looking, we auto decision based off of minimum credit requirements that a customer must have to be able to be underwritten by our analysts. But in the subprime market, we completely believe in a physical underwriter reviewing it before any kind of approval is put out. So although the system goes through and looks at all these pieces of information, our analyst is still at the end of the day approving or declining that deal.
Okay. And I noticed, I'm sure this audience will know, but can you spell out what's FCRA? You mentioned the FCRA in your presentation.
It's just the fair lending regulatory compliance.
Oh, right. Fair Credit Reporting Act. Okay.
Yep.
As I say, this audience will know, but I thought I should call you on that. And without giving up anything proprietary, is there some unexpected variable that you find is highly predictive of what you're looking for that maybe would be unexpected? Again, I don't expect you to give away the store.
Yeah, no, that's fine. So when we look at our alternative data, we look at it on more of a holistic model sense. So it's, like I said before, it's many data sources feeding into one score. So identifying one of those is going to be, I know the rank order of them. However, it all kind of correlates with each other, and each one's somewhat dependent upon another in the way that it's kind of built. So I wouldn't be able to kind of outline exactly what our highest predictor is in our alternative data, but you can identify it, like I kind of mentioned before. And alternative data is not only the data sources that you're including in your model. You can also incorporate alternative data in employment verification, where you get significant lift on the front end, knowing and getting confidence in a consumer if their income if their income validates from the start. You can also, like I said in the earlier slides, that you can be more marketable to the dealers, providing less burden for paperwork and requirements that the customer needs to bring in. Because many of the lenders in our space, including us, require proof of income and proof of residency on many of our deals. So removing that, but still having the assurance that is validated, gives us a big lift in predictiveness and overall efficiencies.
Yeah, it occurred to me to ask that, the improvement in data, the improvement in analysis also applies to the traditional measures too, right? Such as proof of income, time and residence, those kind of things.
Absolutely.
Okay. And also, without necessarily naming names, unless you feel like it, are there vendors for alternative data that are kind of a one-stop shop, or is there a whole smorgasbord of ones that specializes in rental data, somebody else specializes in something else, or can you get it all from one place? How do you do that?
Well, one of I think the biggest drivers of the alternative data is the fact that your nationwide consumer credit reporting agencies, your Equifax, your Experian, your TU, they're all developing different solutions that include alternative data or alternative solutions that include time series data. So with those types of solutions, you can better evaluate, you can better integrate because you're already integrated with them, and you can have the trust and the comfort that they are going to be regulatory compliant, because they deal in that on a daily basis. That's a large majority of their life. It's centered around weathering the regulatory climate and ensuring that the data they're providing is adversable and sufficient for the consumer. But there are other vendors out there. There are many different vendors that specialize in different aspects of the alternative data space, but it's just important to understand that you want to make sure whichever vendor that you go with they have enough diversity in their information that you're not kind of segmenting out one specific group or disparately impacting one specific group within that data set.
Right, and that's a loaded term. Yeah, I was going to ask, are the regulations keeping up with the new non-traditional data, or is it do the same regulations apply, or are you burning up a lot of brain power figuring that out? Are there new rules being written, or the same old rules apply?
I think you have to fit into the same old rules that were applicable to traditional data. So whatever information you want to reach out to it still needs to fit into the mold of your traditional data requirements. There are new and innovative processes going on right now using, like I mentioned before, kind of social media information, which can be inconsistent, but it can also give you a lot of insight on, in particular in your direct marketing kind of campaigns and those types of spaces. So those pieces, as you know, those areas are continuing to grow and continuing to expand and continuing to develop. So I don't know, and I don't think that the compliance side of that is completely caught up. And that's where the gray area kind of comes into play. If you want to get into that area, you're going to want to spend a lot of time and energy with your team and with your legal team and with the legal team of the data provider to ensure that whatever you're using that information for can be perceived and can fit into their traditional sense of their traditional requirements of data.
Yeah, and you made the point earlier too that it's important to have the compliance people on board from the get-go if you want to go into this sort of data, right?
Absolutely. It's one of those learned processes too. You just want to make sure that at the end of the day, after you spend all that time going through your model, validating your results, working with your team to incorporate this information into your system, and then legal does a review and says that I'm not comfortable with these two attributes in your model, you need to take them out. Well, hopefully they're not the highly predictive attributes that are really driving the model, because that could really affect you at the end of the day. And also,
right.
Going through that whole process, you don't want to be in a position where, again, that buzzword, you're not disparately impacting any of the demographics that you hadn't intended to do in the first place.
Okay. And let me ask you one last one. That this came up at a conference I went to recently. That one of the presenters said that lenders were making a lot more loans to people with no credit score, and what he said, the reaction he got from the lenders was that, well, it's not as many no scores as you think, because we're able to assign a score to a lot more people than you realize. Is that the sort of thing you're talking about?
Absolutely. And it's becoming more and more prevalent, too. The more and more studies that these companies do and that these research institutes do, the more they validate the fact that it is a large population of consumers that aren't traditionally scorable, but with full alternative data, and full, I mean both good and negative attributes within that data, you can really start to rank order those consumers and really start to price those consumers in a comparable range as your average consumer that has a file or has a thick file. And there's a large opportunity in that segment, but it's one of those opportunities that you just want to tread very carefully.
Right. Okay. And finally, too, I just have heard anecdotally that there are also a lot of people who underreport their income. Do they not? Do you find that sometimes?
Yeah, absolutely. Underreport their income. I don't necessarily think we find that too often, unless you're dealing with self-employed or some owner of a business.
Okay.
But no, we don't necessarily see too much of that.
Right, but it happens. Okay. Well, thanks, and that's all we're going to have time for today. Auto Finance News is committed to bringing you quality content on best practices in auto lending and leasing. Please be sure to keep an eye open for additional events. Thanks again to our speakers, to Flagship, and to our sponsor, Equifax. This concludes today's teleconference. Have a wonderful day. Thanks again.